One way that our educational system doesn't really prepare us for our future is by neglecting to teach us about taxes and income and different financial responsibilities that you're going to have. In your 20s, whether it's early, late, mid, it's pretty simple to do your taxes because at this point you most likely aren't married, you probably don't have kids, and you have a single income. So today I want to talk about some of the different tax deductions and credits that you can use to try and take advantage of your position and save as much money as possible when you go to do your taxes. So this is mainly going to be geared towards people in their 20s, again, single, no kids, probably went to college or went to school somewhere, and now you're out working and need some ways to save money with taxes. So we're going to go over a few different things like your standard deduction, student loan interest deductions, no tax on overtime, savers credits, and no tax on car loan interest. So we'll dive into each one of those and kind of talk about how you get it, what it's for, and if you're eligible. They really don't teach you this stuff, so I want to do my best to talk you through it and help you out. So we're going to start right away with the standard deduction. So if you've ever filed your taxes before, you probably know what this is because this is probably what you use. When you go to file your taxes, you can either use the standard deduction, or you can individually count up all of your deductions that you may have and see which one is worth more. In your 20s, that's most likely the standard deduction. For the tax year of 2025, the standard deduction is set at $15,750 for singles. Obviously, if you're married filing together, it's going to be like double or a little bit more than that, whatever it is, but it's $15,750 for people filing individually. So what you do is you take that standard deduction, unless you'd rather use your itemized. If it's greater, usually, like I said, standard is greater, and that would be what you use to knock down your income. And then that's how you'd get your adjusted gross income. So something that everybody should know about. Pretty simple. Most likely you've been using this, and it's most likely going to be more than if you were to add up individual deductions. Now, the next one I want to talk about is going to be student loan interest tax deduction. So like I said, if you went to college, went to trade school, whatever it was where you had to take loans out specifically for education, this is going to apply to you. It's important to note that this is a deduction, not a credit. So difference between deduction is you're going to be subtracting that from your gross income to make it look like you made less money to then have a lower taxable income. A credit is something that you're going to get and is going to be applied to the amount of taxes that you owe. So big difference between the two. And this is what we call an above the line deduction. So you can use this deduction along with the standard deduction. Like I was talking about, some people will use itemized deductions or the standard deduction. Basically, if you take your standard deduction, you won't be able to use the itemized deductions. So that's why it's important to note that this one can be used with the standard deduction. But what it allows you to do is deduct up to $2,500 from your taxable income. That $2,500 being student loan interest. So if you paid $1,200 in student loan interest, that would be what you're able to deduct. It's just up to that number. And this can be applied to either federal or private loans as long as they were used for qualified educational expenses. These qualified expenses would be tuition, fees, books or supplies, and your room or board. It's important to note that there is an income limit for this, so if you make more than $90,000, deduction is not available to you. As well as if you make somewhere between $75,000 and $90,000, the amount that you're going to be able to deduct is going to be reduced. Now, most likely when you're fresh out of school, you're not making more than $75,000. You're probably somewhere around 50, 60. So this should apply to most of your younger 20s. There are a couple of other requirements for this, so that being that you need to be legally responsible for the loan, the interest needed to be paid in that tax year, and you can't be claimed as a dependent on somebody else's tax return. So to gain access to this information, you'll either have to look at the federal website or the private loan website to see if they have that information available. But if you paid more than $600 worth of student loan interest, then you should receive a form called the 1098E, which will have that information. So this is important to note because if you went to school, you're most likely paying money on loans, and some of that is going to be interest. So you want to make sure that if you're doing this anyway, that you get this deductible applied. The next deduction we're going to talk about is no tax on overtime. So this is a new deduction implemented with the big beautiful bill that was signed, and it is slightly deceiving. So it's not exactly no tax on overtime, like your entire pay. It's going to be no tax on the 0.5 of the 1.5 times normal pay. So usually you get time and a half. It's no tax on that extra half. So if your normal pay is $10 an hour and your overtime pay is $15 an hour, there's no tax on the $5. So it's the extra 0.5 of the time and a half that's not taxed. So a little bit deceiving in that way, where it's not exactly no tax on overtime, it's no tax on the extra money from overtime. This is something that's new, so employers are not required to separate your overtime for the year, like your year-to-date overtime, on a W-2. So you'll have to look at your pay slips and find your year-to-date overtime and use that for the deduction. However, starting next year, employers are going to be required to have a separate section for your year-to-date overtime. That way it's easier to file. And then, what you would do is subtract that money from your gross income, so essentially you're not paying taxes on it. If you're somebody who makes a lot of overtime, this is definitely something that's important. If you only make a couple hundred in overtime, it's not going to make a huge difference, but it's still better than nothing, and technically you're not paying taxes either way on that overtime. Now, the next thing we're going to talk about is actually a credit, so it's not a deduction. And like I said before, what a credit is and how it's different is that you'll apply this to the amount of tax that you owe in the end. And this one is called the Saver's Credit, and it's super important because in your 20s is when you're really going to qualify for this, and a lot of 20-year-olds or 20-something-year-olds neglect their retirement and pretend like it's not going to happen. They can't think past 30, 40, 50 years and the fact that they will eventually be 65, they will eventually want to retire. So this is kind of an incentive to put money towards your retirement. So how it works is if you put money into a qualifying retirement account, the government might give you a credit worth either 10%, 20%, or 50% of your contributions throughout that year towards your taxes. Now, we'll get into the income limits in a minute, but the accounts that are eligible would be a traditional IRA, a Roth IRA, a 401k, 403b, 457b, a simple IRA, or a SEP IRA. If you're not sure what any of these means, go check out my other video where I break down different types of investment accounts. That'll be the guide you need to know what all of these mean and how they work. But regardless, these are all retirement accounts that you would be putting money into. Specifically speaking, the 401k is something that usually most employers offer, and they offer a match anyway. So usually you're already putting in about 3 to 6% of your paycheck. So all of those contributions would be eligible towards this credit. So something that you should already be doing anyway, and it's just free money towards your taxes. So this is something to pay attention to if you're eligible. The credit is eligible on up to $2,000 worth of contributions, which means if you qualify for the 50% credit of your contribution, that's $1,000 of free money towards your taxes. Like I mentioned though, there are income limits. So if you're filing as a single, your adjusted gross income is what's going to determine your eligibility. Adjusted gross income being after your standard deduction, if that's what you take, or after your line item deduction, if that's what you decide. So the first bracket to qualify for 50% is from $0 to $23,000. The next bracket is going to be $23,001 to $25,000, and that's going to be 20%. And $25,001 to $38,250 would be 10%. So if you're over that $38,250, you don't qualify. But again, this is adjusted gross income, not your overall income. So a real scenario that somebody could be facing is if they make $50,000 minus their standard deduction of $15,750, their adjusted gross income would be $34,250, which means you fall into the bracket of a 10% credit. 10% of $2,000, which is the maximum contribution, would be $200 worth of credit. So that's $200 that you don't have to pay in taxes. Now, one important distinction on this is that this is a non-refundable credit. So it will go towards the amount of tax that you owe, but you will not get the money back if you owe $0. So let's say that same person we were talking about has a $200 credit, but they owe $1,000 in taxes. So you would subtract the $200, now they owe $800. Or if this person owed $100 in taxes, they would subtract the $200 and owe $0 because they wouldn't get an extra $100 back. It's just up to the amount of taxes that you owe. There are a few other requirements for this, and that is that you have to be 18 years or older. You can't be claimed as a dependent on somebody else's tax return, and you cannot be a full-time student for 5 or more months throughout that tax year. And they define a month of being a full-time student as being a full-time student at any point throughout that month. So if you just graduated from college as a full-time student, you were probably in school from January to May. So that would be 5 months and you would not qualify. So if you just graduated, you most likely will not qualify for this credit in that past tax year. But if you do qualify, it's still better than nothing. It's literally free money off your taxes. And if you were doing this anyway, which you probably are with a 401k or Roth IRA, then why not apply for it? Because it's just money back or money off. It's just a discount off your taxes. So again, something that you're probably already doing. And that's kind of the idea of these taxes in your 20s, is that you're probably already doing these things and you're just missing out on the free deductions or the free credits. Now, the final one I wanted to talk about was no tax on car loan interest. This was another thing introduced in the Big Beautiful Bill. Again, very deceiving in a way because we're going to get into the specifics. It's not just any car loan. It has to be a brand new car for one, so it can't be a used car. And the loan had to have started after December 31st, 2024. So it had to have been bought, or the loan had to have been started in 2025. Important to note that this is going to be a temporary deduction, so it's only going to run from 2025 to 2028, unless of course it gets extended. At this point, it is just 2025 to 2028. Now there are a couple more stipulations here. The car must have been finally assembled in the US, and the car must be used for personal use. Now, if you qualify for all of those things and you are paying car loan interest, you can qualify to deduct up to $10,000. Now, again, it has to be the interest. It has to be a brand new car made in the US, started in 2025. But if this applies to you, this is something that's very important to know. A lot of people in their 20s are, when they graduate, are driving just beater cars, looking to buy a new car that's something reliable. And if that's you, or maybe you just bought a new car and didn't even know about this, definitely look into using this. There are some important income limits here. $100,000 if you're filing as a single, $200,000 if you're filing joint married. Not going to apply to everybody, and I was bummed to find out that my car doesn't apply, but it's whatever. Still something to be aware of. All right, and those are all I have for you today. Just some simple deductions and credits to be aware of when you're going to file your taxes. Just things that really are not well advertised because they don't want you to know these things so that you don't do them and that you don't take money away from the taxes that you'd be paying. But hope you learned something, whether or not you knew about these things or the specifications of them. Now you do, and you can apply them to your taxes. If you know anything else beyond this list, feel free to share that in the comments. This is just a short, brief list of things that I've found. I'm sure there's a million other ways to legally avoid paying taxes or reduce the amount of taxes that you owe. So yeah, hope you liked the video and learned something. Catch you next week with another one.